Sorry for being late. Now we'll start with Keynesian determination of equilibrium output. So I have already drawn the diagram. So this shows aggregate demand curve, and we can notice that at Y note, this point, actual aggregate demand is greater than expected aggregate demand. It implies excess demand for goods. In this case, there will be unwanted decrease in inventory. Therefore, firms will expand their output to Y1 to keep pace with market demand. Firms increase their output at point 1 and AD increase at MPC C and will continue till Y is equals to AD line intersected actual aggregate demand at point J, this point. There is deficit demand, not excess supply. Due to which uh, at Y2 actual demand is greater than expected aggregate demand. This implies unwanted increase in inventory due to deficient demand. Therefore, firms reduce their output and there will be downward movement on both curves. This reduces output at 1 on y is equals to AD at in it also reduces AD at MPC. It continues till AD curve intersects y is equals to AD, which represents actual output produced. In a three-sector model, Keynes added government expenditure as an autonomous model and lump sum tax, that is, a constant amount of tax imposed in the market. So y is equals to C plus I bar plus G bar. C, as we all know, is autonomous autonomous consumption plus MPC into disposable income. Disposable income is income minus lump sum tax. Now we write it in the equation AD is equals to C bar plus CY minus T plus I bar plus G bar, which will be C bar plus CY minus CT plus I bar plus G bar. Now we let all the autonomous components as let C bar plus I bar plus G bar is equals to A bar, autonomous variable. Then AD will become A bar minus CT plus CY. And to draw another graph for this, this is Y is equals to AD. This is aggregate demand curve. This is equilibrium at point Y1. Now let's move on to Keynesian explanation of the Great Depression. So Keynes provided that concept of deflationary gap to show that equilibrium can take place before full employment due to lack of sufficient aggregate demand in the economy. Under deflationary gap, actual AD is less than expected AD at full employment level of output, or there's deficient demand at full employment level of output. According to Keynes, this is happened because of negative expectation or lack of animal spirits in the economy. Demand remains low because people assume that their income is insecure without falling employment, crashing markets, and decreasing economic activity. Less demand by people creates bearish sentiment among firms, which then reduce investment. This leads to the deflationary gap. Both C and I remain less, leading to less AD. Keynes represented deflationary gap as this. So let me just draw. Actually, I can use the previous one. So yeah. So Keynes said that deflationary gap is actually this. So there should be movement back to air, and Hj is the deflationary gap. That is the difference between actual aggregate demand and aggregate demand needed for full employment equilibrium output. Keynes showed, unlike the classical economics, there is possibility of underemployment equilibrium. That is, it is not necessary that demand is always sufficient to provide full employment equilibrium. So Keynes differed from classical economists. Keynes said there is possibility of underemployment equilibrium, which means that it is not necessary that demand is always sufficient to provide full employment equilibrium. In pure Keynesian model, fiscal expansion is the only policy method to assure that the economy reaches full employment. To assure that the economy reaches full employment by increasing AD. This can happen by shifting AD curve upwards, by increasing government expenditure, or by reducing taxes. So either you increase government expenditure or you decrease the taxes to shift AD upwards, which can increase the consumption expenditure. Deflationary gap was a representation of economy going through recession, and according to Keynes, the only way to remove this recession was to increase aggregate demand through expansionary fiscal policy. During 1940s, America had 37% of global manufacturing. After Marshall, Kalaba Plan was introduced for Japan and South Korea. So, during the World War, Hicks, along with Robinson, provided the theory of inflationary gap to explain the role of AD and policy making in business cycle management. Theory of inflationary gap to explain role of AD and policy making. VKRV Rao's criticism on Keynes was that YF can shift. So this is output. This is Y is equals to AD. Then we have AD bar and AD. So they said that this is the inflationary gap, this region. This was YF and this is Y1. Inflationary gap FM at YF full employment. So inflationary gaps takes place when equilibrium is at a level of output which is higher than full employment. In other words, at full employment output, there is excess demand for goods. That is, actual aggregate demand is greater than expected aggregate demand. This was defined as representation of a boom period in which inflation will rise with nominal value of output rising because of real output cannot rise beyond YF. Now fiscal contraction will be needed. So, which is decreasing the government capex and increasing the lump sum tax. Inflationary gap can be controlled by reducing government expenditure or increasing tax. This will reduce AD and shift actual AD downwards such that there is equilibrium at point M at this point. Now we move on to derivation of multiplier in Keynesian model. So, so there is something called autonomous multiplier under Keynesian model. Uh, it represents the constant which increase the rate of change in output due to a given change in autonomous variable. So AD is equals to C bar plus I bar plus G bar plus CY minus CT. In equilibrium, Y is equals to AD. So Y is equals to A bar minus CT plus CY. Y minus CY is equals to A bar minus CT. Y common 1 minus C, A bar minus CT. Then we have Y is equals to 1 upon 1 minus C and del Y upon del A bar is equals to 1 upon 1 minus C. This is the autonomous multiplier. The value of autonomous multiplier is directly related to MPC because higher MPC will imply larger proportion of income spent back to the economy. So now deriving lump sum tax multiplier. AD is equals to A bar minus CT plus CY. In equilibrium, Y is equals to AD, so Y is equals to A bar minus CT plus CY. Y minus CY is equals to A bar minus CT. Y 1 minus C. A bar minus CT. Y is equals to 1 upon 1 minus C. A bar minus CT. Now we will derive the lump sum tax multiplier. So we will differentiate by tax. So it will become minus C upon 1 minus C. This is lump sum tax multiplier. The negative sign is due to inverse relation between change in output and change in tax rate because any increase in tax will reduce disposable income, which will reduce aggregate expenditure. Similarly, decrease in tax will increase disposable income, resulting in higher expenditure. In expansion, it is more beneficial to have growth through government expenditure. rather than tax reduction because because multiplier on government expenditure is greater multiplier on tax reduction. Absolute value of lump sum tax multiplier is lesser than autonomous multiplier. So because any change in tax will not hold on. So this is point one. Second is absolute value of lump sum tax multiplier is lesser than autonomous multiplier because any change in tax will not result in an equal change in aggregate expenditure. It will result in changing expenditure by MPC times the change in tax. This is because the entire disposable income is not consumed by households, a part of it is also saved. However, in case of increase in autonomous value, there is actual increase in aggregate expenditure. Therefore, choice of G bar or T depends on intent of policy. So, for example, if government follows expansionary policy, then to remove recession alone, then it can increase G bar. However, if the objective is not only to increase GDP but also to promote consumption-led growth, then government reduces tax rate. Now we derive transfer multiplier. So in presence of transfer payment, AD is equals to C bar C plus I plus G. C is equals to C bar plus C Y minus TR transfers minus lump sum tax. So now in equilibrium, AD is equals to A bar plus CTR minus CT plus CY. Y minus in since it is in equilibrium, so Y minus CY is equals to A bar plus CTR plus CY. Y1 minus C is equals to A bar plus CTR plus CY. Y is equals to 1 upon 1 minus C A bar plus C TR bar plus CY. Sorry, I did one mistake. Since CY is being taken that side, it is not plus CY, it is minus CT and minus CT. Yeah, so now delta Y upon delta autonomous variable is 1 upon 1 minus C delta plus delta C delta TR minus C delta T del Y upon del CTR is equals to C upon 1 minus C. This is same as So autonomous transfers create a multiplier impact by inducing consumption. Therefore, for every increase in transfers, aggregate expenditure rises MPC times and value of multiplier is C upon 1 minus C. Yeah, it looks like lump sum tax multiplier, but since there is a negative relation between output and tax, so that has negative on numerator, but it is on positive. Now we move on to balanced budget multiplier. Yeah, so budget is G minus T. In a balanced budget, we have G is equals to T. If G is greater than T, then we have deficit. If G is less than T, then we have surplus. So AD is equals to C plus I plus G, which is C bar plus C Y minus T plus I bar plus G bar. In equilibrium, we have Y is equals to C bar plus CY minus CT plus I bar plus G bar. Let T is equals to G since we are getting the balanced budget multiplier. Y minus Cy is equals to C bar plus I bar plus 1 minus C 1 minus C G bar 1 minus C Y is equals to C bar plus I bar plus 1 minus C G bar. Therefore, Y is equals to 1 upon 1 minus C bar plus I bar plus 1 minus C G bar. Delta Y is equals to 1 upon 1 minus C delta C bar plus delta I bar plus 1 minus C delta G bar. If delta C bar and delta I bar is equals to 0, then so balanced budget multiplier with lump sum tax is 1. Balanced budget multiplier theory was introduced by Charles Wickstead. So after World War II, it showed that government could increase aggregate expenditure without increasing its fiscal deficit. Government can increase aggregate expenditure without increasing fiscal deficit. By practicing balanced budget, it showed that if tax amount and government expenditure are changed by same magnitude, are changed by same magnitude, and in same direction, then aggregate expenditure will increase by same amount on government expenditure. This is because an increase in government expenditure has complete impact on total expenditure and an increase in tax reduces aggregate expenditure by MPC times. Therefore, total expenditure and output increase by the same amount as delta G or delta T. Multiplier value is 1 because the impact of increase in tax with increase in government expenditure is 1 minus C times the aggregate expenditure, which cancels the multiplier impact of 1 upon 1 minus C by C magnitude. Next, we will do autonomous multiplier and furthermore. Thank you.